All right, just looking a little bit behind the definition of gross domestic product. So the basic idea is we're measuring the income of the country as kind of a general indicator for well-being in the country. And if you think about for an individual for well-being, a lot of times if you didn't know someone, you wanted to kind of figure out how they're doing, you would say, well, what is their income? And that would give you an overall picture of their standard of living. And it's the same thing for a country. So we want to look at the income of the country, and why do people earn income? Because they're creating goods and services or wealth. So look at the definition, gross domestic product. Emphasis on the domestic product component is going to be the production of a country. So one thing we're going to do for measuring the income of the country is we're actually going to add up all the spending in the economy. And the basic logic is this, that every dollar that someone earns for an income, someone else had to spend a dollar for that person to earn it as an income. So every dollar of spending or expenditures equals a dollar of income. So the way we're going to calculate gross domestic product is we're going to just add up all the spending in the economy, and all that spending is on goods and services or wealth, which would equal the total income. One quick example, if someone does a landscape service, let's say a landscape install, and they earn an income of $500 from that install, well, someone else had to spend or make an expenditure of 500. So either you could measure that wealth created on the income side, that wealth was that landscape, it was worth 500. Well, someone earned 500 of income for it, that measures the wealth of that product. Or you could look at it from the spending side, that someone had to write a check for 500